in business activity. On the demand side, the momentum in private consumption is expected to sustain next year. Rural demand remains steady with improving agricultural activity and rural labor market conditions. Recovery in urban consumption should further strengthen, with continued support from GST rationalization and monetary easing, among others. High capacity utilization, accelerating bank credit, conducive financial conditions, and government's continued emphasis on infrastructure should give an impetus to investment activity. Moreover, several measures announced in the budget should be conducive for growth. You are all aware that one of the kartavs, one of the pillars in the budget has been on sustaining growth. The recently concluded India-EU FTA and the prospective India-US trade deal, along with several other trade agreements, will support exports over the medium term. Services exports should remain resilient. The spillovers emanating from geopolitical tensions, volatility in international financial markets, and shifting trade patterns pose risks in the outlook. Taking all these factors into consideration, real GDP growth projections for Q1 and Q2 of next year, that is 2026-27, are revised upwards slightly to 6.9% and 7% respectively. The risks are evenly balanced. I may mention that we are deferring the projections for the full year to the April policy, as the new GDP series will be released later in the month. I now come to inflation. Headline CPI inflation remained low in November and December, even as it firmed up by 1 percentage point in these 2 months. This increase was largely driven by the lower rate of deflation in the food group. Excluding gold, core inflation remained stable at 2.6% in December. Near-term outlook suggests that food supply prospects remain bright on the back of healthy kharif production, sufficient buffer stocks of food grains, favorable rabi sowing, and adequate reservoir levels. Core inflation, barring potential volatility induced by prices of precious metals, is expected to be range-bound. Geopolitical uncertainty, coupled with volatility in energy prices and adverse weather events, pose upside risks to inflation. In terms of the headline inflation trajectory, despite the anticipated momentum being muted, unfavorable base effects stemming from large decline in prices observed during Q4 of last year, that is 2024-25, would lead to an uptick in year-on-year inflation in Q4 this year. Considering all these factors, CPI inflation for this year, the current year 2025-26, is now projected at 2.1%, with Q4 at 3.2%. CPI inflation for Q1 and Q2 next year are projected at 4% and 4.2% respectively. Excluding precious metals, the underlying inflation pressures remain muted. The risks are evenly balanced. Again, in view of the impending release of the new CPI series on February 12, as I mentioned for growth, we will be presenting our CPI inflation projections for the full year 2026-27 in our next policy statement in April. I will now be talking about the external sector. Despite heightened uncertainty, global trade remained relatively robust. India's merchandise exports, supported by trade diversification efforts, grew by 1.9% year-on-year in Q3 25-26. Merchandise imports grew by 7.9% during the same period, resulting in a widening of the trade deficit. Robust services exports and healthy inward remittance receipts would, however, keep India's current account deficit for the current year moderate and sustainable. Moreover,